value acquisitions, how you should only buy the best businesses. So in this video, I will be talking about value acquisitions, which is a concept that I've been developing over time. Now, full disclosure, this particular idea and this theory of value acquisitions was born out from the teachings of four main people. And these four main people are, number one, Charlie Munger. The first person who I really took a lot of inspiration from when it came down to value acquisitions is Charlie Munger. The second person is Peter Lynch. So both of these, Charlie Munger you probably have heard of because he just recently passed away. He was Warren Buffett's long-term partner. Peter Lynch was a hedge fund manager who had really beat the market when he was investing in businesses. But these two, they had very similar concepts in how they look at businesses and investments. So value acquisitions really born out of Charlie Munger and Peter Lynch's theories, but also Warren Buffett and Benjamin Graham, who have obviously, there's no introduction needed for Warren Buffett. He's one of the most successful, in fact, the most successful investor in history, and his mentor, who was Benjamin Graham. So these four people are the ones who have inspired me and made me develop this concept of value acquisitions in private businesses. Now, in a nutshell, value acquisitions looks at the business first and price thereafter. So what you're looking for in value acquisitions is how high quality or how good is the business itself, and then look at the price thereafter. Is it priced competitively? I want to quote what Warren Buffett, after he met Charlie Munger, the quote that he came up with is that he used to say, or Benjamin Graham taught Warren Buffett, that he should buy fair businesses for wonderful prices. Fair businesses for wonderful prices. However, when he met Charlie Munger, then it changed to buying wonderful businesses for fair prices. So that's buying wonderful businesses for fair prices. And that's the actual, motto that value acquisitions is all about. So if you want to learn one thing and take away one thing, if you want to end the video from this point on and not watch anything else about value acquisitions, it's all about buying wonderful businesses for fair prices. Now, let's develop this theory a little bit more together, and I'll be making a lot more videos where I develop the theory on this over time on value acquisitions. And just, if there's a particular video on my channel which is a case study of the most recent acquisition that I did, go and watch that, because that talks about a lot of the concepts of value acquisitions as well, in addition to this one. So let's get fired away. I've got my notebook in which I am going to be, because I've been developing this over time, I've got 3 or 4 pages worth of notes on value acquisitions. When Charlie Munger, Peter Lynch, Warren Buffett are looking at the business itself, of how good the business is, this is even more important with private businesses, because of course, if you are going to invest in a public business, generally speaking, these public businesses have generated some sort of traction behind them. Normally, a business doesn't go public unless if it's got at least like $500 million or $1 billion worth of revenues and good profits. Now, of course, there could be instances in which profit goes up and down, revenues go up and down, but it's actually gained some traction in the marketplace. But with private businesses, they generally don't gain that same level of traction. We're talking about small to medium-sized businesses. So these are businesses with a revenue of anything from 1 million all the way up to 150 to maybe even 200 million in revenue, and these are the type of businesses that we're looking at. So if we're looking at these type of businesses, it's even more important that we look at the business itself to see, is it a high quality business? Is it being run by a good management team? So the first thing that you need to look at when you're looking at a business for a private acquisition from the lens of a value acquisition is that the product or service that is delivering, is it providing true value in the marketplace? But most importantly, it's not just about the product or service, if it's delivering a high quality, valuable product or service to the marketplace, but how do the customers perceive that value? So do they perceive it to be valuable or not? For example, you can have a fantastic business which is providing a really high quality product, but for whatever reason, they're unable to deliver that value to the marketplace, and therefore the consumer, in the mind of the consumer, they don't value that product in the same way that the business does. So it's really, really important that you look at it from the lens of a consumer. And when I say consumer, I mean the business. It could be selling B2B. If it's selling B2B, then that marketplace that it's selling to, does it perceive that to be a high quality proposition, that product or service? So if you're selling accountancy services, you're selling normally accountancy services to other businesses. So if you're able to demonstrate value, that's why, for example, PwC and these big, massive, accounting companies, the consumer recognizes them to be or providing a very high quality service. So therefore they go to them. The same way, when you're looking at a business acquisition as a value acquisition, you look at the consumer, you look at the customer, whether it's an individual consumer as a personal consumer or that's a business. Do they perceive that product or service in the same light in which the business is trying to show to market their services and products? So if they do, then that's great. Then you can move on to the next step. If they are achieving that perception in the marketplace, then is there a strong enough moat or a wide enough moat around that? So what is a moat? Warren Buffett talks about a moat. Benjamin Graham talks about a moat. And a moat is basically a barrier, a ring around the business. Is that how easy or difficult it is for another competitor to come and take away market share. So if there's a business, for example, and it has, it's got massive market share, then that is something which has a very wide moat around it. Now, these small businesses, medium-sized businesses that we are looking to buy, they won't have huge moats, but what they can have is that they can have localized moats and they can have industrial moats. So what does that mean? So for example, if you have a localized moat, that means that you're perceived to be the best business in a particular area of that particular product or service. So think about your area and think about the top 3 best restaurants in that area, in your particular area. You'll have immediately think, okay, that one, and that one. And you'll already know that these 3 are the best restaurants in my area and there's no other restaurants that come up to that. Now, how easy or difficult is it for another restaurant to come and open up and take the spot of that particular restaurant? So let's say, for example, you thought of the 3 top restaurants in your area, but then you say, right, there are 1 or 2 of them which is very, very difficult to take away their position in the local marketplace. Those 2 are the ones that have the localized moat, because it's very difficult to take market share away from them. The other thing is you can have is industrial moat. And what that means is that you look at a particular industry. For example, if it's selling nationally, you look at a particular industry and say, right, how much traction does that particular business have in the particular industry that it's serving? And how easy or difficult is it for it to take away marketplace? So there was a plumber in the UK. He had this company called Pimlico Plumbers. And it was very difficult in London to take away market share away from him. There were there's thousands of plumbers in and around London, because of course there's so many people that live here, but no other plumbing company would be even close to Pimlico Plumbers. And that's why that has an industrial moat in the local area of London, or in the city of London, and therefore no one could come and even come close to the type of customers that it was serving, the amount of revenue that it was generating, and the perception that that business had in the marketplace for high quality plumbing services. Now, also with regards to the business itself, these private businesses, is that generally the management team should be independent of the owner. So there are some cases in which the owner can be involved in the business, but they can't be involved in overall management or sales relationships. Can't have that kind of relationship. They could be involved in other ways in which it's easy to replace them, but generally speaking, the management team needs to be independent of the owner, and they need to be doing a good job of a sustained period of time. When you're buying small to medium-sized businesses, what you need to look at is the last 5 years worth of growth of the business. Management team should be around for at least 2 years in its current form, independent from the owner. And they should show one of 2 things: either sustained revenue and profits, or growth. Growth is obviously better, but even if it's got sustained revenue and profits, that's also an opportunity, because you can come in and make some changes to ensure that the growth comes in. And therefore, because if you've got a business which has got sustained profits and sustained revenue, you can normally buy it for a cheaper price, which we'll talk about price at the end of this video. But you can buy it for a good deal, and then therefore you can improve, and the value that you get from owning the business gets even higher. Because there's one big difference between value investing and value acquisitions, is that value acquisition, generally speaking, you will be able to add value to the business and therefore increase the amount of profit and revenue that the business makes for you. Where with value investing, the management team is completely independent from the shareholder, and unless you're active as shareholder, then it's very difficult to have any influence on the particular business when you're value investing. But you can have that impact on the management team. So therefore, management team will at least sustain revenues and profits for at least 2 years. Now, there's no good, for example, you'll find this a lot in the small to medium sized business space when you're going to acquire businesses, is that owners all of a sudden they think, right, I want to sell my business. So they get management and they put them in place. And those management, the management has only been in place for like 6 months. That's not enough time for you to see whether that management team can manage the business and hold the business for over the long term. So that's why I say at least 2 years. 1.5 years is touch and go. 1 year is too less. Why? Because you need to see that in the accounts. You need to see that over a longer period of time. 18 months is the absolute minimum. 2 years is at least 2 years is ideal. That's the kind of bottom end you're looking for. Now, if it's got management team in place for 5 years, 10 years, for example, that's the best scenario, and you want to go and buy that. Now, if, for example, you want to buy an owner-managed business, then there are other things that you need to look at, and that's how easy is it to replace the owner? How difficult is it to replace the owner when you buy this business? And what is that transition period going to look like? That's going to be a topic for another video. So let's move on from there. But I just want to drop that in. So if you are looking at an owner-managed business, then how does it fit in value acquisitions? The next thing to look at is, following on from the management team, is the available workforce itself. So not the management, but the general workforce. Now, there's 2 types of workers that you have in the marketplace. There's skilled and unskilled workers. And a business which is able to operate with unskilled workers is a better business to buy. And I'll tell you the reason why is because you don't have to pay high salaries to unskilled workers, and it's easier to train them into the job itself. If you have to have skilled workers, normally it's a more competitive marketplace to attract talent. And if you've got, for example, a great talent attracting policies or recruitment process, then that's great, and that's something that you need to look at. So generally speaking, if you can buy a business in which there's unskilled workforce and you can easily recruit anyone and train them up to run the business or work in the business, that is a better business to have, meaning an idiot can run it. Why? I think Warren Buffett says an idiot can run it, or something like that. A bad management team can run it. Why? Because a bad management team will end up running it. So you apply that to the workforce itself. And by the way, that's actually true for the management team too. So if you can have an unskilled management team and an unskilled workforce, then that is a better business to buy. But if you've got a skilled workforce which is required, you really need to look at how do they attract talent. If they're attracting talent, they've got a good recruitment process, then that's something that you can go ahead and buy. Unless, for example, you're a strategic buyer, and you've got a great talent attracting process in place already, then that's something that you can just implement in the business that you are looking to buy. The next thing you have to look at with regards to small to medium sized businesses is the marketing strategy, the ability of the business to attract new clients, and also once a client is interacting with the business, what's the lifetime value of that client? So there's 2 things. Number one is most businesses don't have a predictable client acquisition strategy. They just don't. In the small to medium sized business space, I've only seen very few businesses. So if you were to put it on a scale of 1 to 10, there's probably 2 or 3 businesses which have a good client acquisition strategy, and most businesses don't. They rely on word of mouth, which is an opportunity for us, of course, because we can implement marketing strategies and client acquisition strategies in and really grow the business in a way that the old owners haven't been able to do it. So how do they attract clients? Do they do it profitably? And for example, if they don't have a marketing attraction strategy, then you need to have one. Because if you don't have one and they don't have one, then that's not a good business to buy, right? Unless, for example, they've got a lifetime value. So if their current customers are on some sort of subscription or some sort of, for example, repeatable business model, then that's also good. So you have to look at the business and identify what is the client acquisition strategy and what's the lifetime value of each customer. And if they've got a predictable way of acquiring new clients, great. If they've got a high lifetime value, then that's also great. The more important one, for me anyway, is lifetime value. The reason is because I can attract clients. I've got expertise in bringing customers into the business. But what I need to look at is that, does it have a good lifetime value for each customer? Because if I can extract more revenue per customer, then I know that I am got a winning business strategy there. And that's what you need to look at. So the marketing process and their overall lifetime value of each customer. And finally, once you've looked at all of those things in terms of the necessity of the product or service, the product market fit, if it fits into the criteria of mass market, premium, or luxury, and it's got a great management team, it's got available workforce, it's got a good talent acquisition strategy in terms of attracting workers, and if it's got a independent management team that can demonstrate over a long period of time with that workforce, and it's got a great marketing strategy or an ability to have good lifetime value for each customer that it brings in, that's what I would classify as the bare bones for a value acquisition. Because the business is now good. It's a wonderful business in that it ticks a lot of the boxes to make it a great business. Now you look at price. Price is now looked at. So who determines the price? The price is essentially determined by you. It's determined by you as a business buyer, and also by the industry standard multiple. So for example, if you have a business in which there has a low multiple, so generally speaking in the retail space, your multiple doesn't go higher than 3. However, if you're going into the healthcare space, then the business can go up to 4 or 5. And if you're in the technology space, it can go even higher. So you need to look at the industry standards and also what you're willing to pay for it based on the return. Remember, the reason why price is also important when value acquisitions is because you never want to overpay. The lower amount that you pay for a business, the less risk it is for you. And value acquisitions is all about lowering risk for you as a business buyer. So when you're in the small to medium size space, negotiation is very, very important. Because in the public markets, it's an auction-driven market. The prices go up and down depending on the market itself. But here, you are essentially negotiating with an intelligent person, and therefore you need to negotiate well. This is not a video for negotiation, but what it talks about is that you need to ensure that you buy for a lower price. So generally speaking, if you can buy a business, for me personally, up to 2.5 multiple, then that would be a good acquisition. Of course, the lower, the better. So for example, our most recent acquisition, we bought at 2 times multiple, and on day one, we only paid 1 times multiple for the business. So that was a price negotiation and a good attractive price. So it's determined by marketplace and is determined by you. In our last acquisition, it was determined by me through great negotiation. So that's what you need to look at when it comes down to buying a business, because no business is worth an unlimited price. It's only worth a certain amount. And you also need to think about that based on your long-term plans. Is that, are you looking to hold these businesses forever? And if you are, then you might be able to pay a little bit of a higher price for these business, because you're going to hold it forever. And especially if you've got a really long time, you need to look at one of the other things. How much profit is this business going to give me over the lifetime of its business? And then you look at the price that you're going to pay for it. So for example, if you think that the lifetime of a business is 20 years and you pay 2 times the multiple, that means you're going to get all of your money back in 2 years, or potentially all of your money back in 2 years. And you've got 18 years worth of free cash, free profit just coming into your bank account. That's what you need to look at. Lifetime value of the business. So the lifetime earning potential of the business, of bringing in profit. Profit in which is after tax, not EBITDA. Profit after tax that you can bring in to yourself versus the price that you're going to pay for it. And you're going to make a decision on price based on that. So for example, if there's a business that you think the lifetime of that business is only 10 years, then what is the maximum you want to pay for that? Do you want to pay 5x for that? That's going to be too much. Why? Because it's only worth, for example, 10 years. You think it's only going to be generating 10 years worth of profit. So paying 5 years worth of profit for that business is not a good investment in any shape or form. So in the private markets for small to medium sized businesses, I like to see a lifetime maximum, I'm talking about, a lifetime earning potential versus price paid of up to 30%. right? Up to 30%. So I'm not going to pay more than 30% of what I think that this business can give me over the lifetime of its business. And of course, that doesn't mean that I always pay 30%. I always pay as low as possible. If I can pay 10% for that or 5% for that, that is the ideal situation, right? But up to 30%. And that's me personally. By the way, that might be different for you. So for example, you may say, right, I don't want to pay more than 20%. That's perfectly fine, right? So it all depends on what your long-term goals are and what your risk appetite is, how much money and capital you've got available through investors, and also how quickly you want to ensure that this generates profit for you, meaning debt-free, meaning completely paid for. The next thing you need to look at is that how often does a business like this come onto the market, meaning how often does it become available? So for example, if you've got a very high quality business which serves a particular type of customer and generates a lifetime value of a high amount, does that business come available onto the marketplace all the time? And if it doesn't, then you might want to pay a higher price for it just to get it under your belt. Why? Because they're so difficult to find great businesses. And if you find a great business, then you want to try and buy that. Why? Especially if it's got long-term earning potential. If it's got 20, 30, 50 years worth of earning potential, then you want to get that under your belt so it can start generating profit for you. So how often these businesses are available in the marketplace does also influence how much you're willing to pay for them to bring them under your ownership. A business operating without the owner is always more valuable than a business which is operating with the owner. Now, this doesn't mean that you end up paying more, but just to know in your mind that a business which operates without the owner is more valuable to you. Why? Because it's already got a track record of running independent of the owner, and therefore once you own it, it'll be independent of you. A business acquisition with a good flexible structure, for example with a large amount of seller finance over a long period of time, you might be willing to pay a little bit more than that for a business acquisition because the structure is really good. And again, you don't have to pay more, but is that you might be a little bit more flexible on the price because the terms are really good. But of course, you never want to overpay for a business because that eats into how quickly you are going to return money to yourself over the course of the lifetime of that business. The most important thing that you need to remember with value acquisitions is that you are willing to buy a wonderful business for a fair price. As long as you keep that as the overarching principle, that wonderful business, fair price, and you make that assessment based on the industry that you're in and the sector that you're in and how much money and capital you've got available to yourself, then you can make the acquisition accordingly. So that's my thoughts on value acquisitions, and I'll be making more videos over time on how we can use value investing principles and apply it to the small to medium business space. So that's enough for this video, and of course, if you want to find out more about how to buy businesses, continue to watch videos on this channel. But there's also a 7-step blueprint to buying your first business, which you can download and get the step-by-step process on how you can buy your first or next business.